Kroger is an American company that operates supermarkets, and over the past year, they are up by 37.15%. Now, over the past 5 years, they have been rising very steadily and are up by almost 120%. And so, in today's video, we will figure out if this steady rise is rationalized and if Kroger is set to keep growing in price into the future, and if buying it now will still yield you return. And to do this, as always, we will use our stock valuation spreadsheet, where we will have a look at the fundamental 9-pillar analysis and calculate the intrinsic value of Kroger using our 4 valuation models. Now, jumping back to the stock screen, we can see that Kroger has a dividend yield of 2.08% with a dividend payout of $1.28 and a very low trailing free cash flow payout ratio of 24.71%, which leaves them a lot of their free cash flow to, for example, pay off debt. And if we have a look down here, we can see that the market cap of the company is sitting at 44.5 billion, while the enterprise value is sitting at 60 billion. And the difference between these two is essentially debt, and paying off this debt is exactly what the free cash flow is used for. Now, another thing that the free cash flow is used for, if we jump to the 9-pillar analysis, we can see is growing the dividend. Kroger has a consecutive dividend of 14.59%. And if we have a closer look, we can see that a yearly growth of 14.59% is much higher than the average year-over-year dividend growth. We can see the very nice steady growth over the past 5 years, where the dividend increased by almost $100 from 2019 to the current time. And this is the one thing that really kicks in the dividend snowball effect and is one of the reasons why I love Kroger. But now let's have a look at some of the other pillars. We can see that Kroger gets a rating of 9 out of 9. So first, let's have a look at their growth. We can see that their revenue has been growing at a rate of about 4.21% yearly. The free cash flow has been increasing as well, and the net income has been increasing as well. But now let's have a closer look at these 3 growth metrics. We can see that the revenue indeed has been growing very steadily. But if we jump to the net income, we can see that that has been on quite a bumpy ride over the past 5 years, but is still up from 1.6 billion in 2019 to 2.1 billion in 2023, and year over year it grew by another 27.87%. And finally, looking at the free cash flow, we can see that that as well has been on quite a bumpy ride, but it did as well grow from 2019 to the current time, but year over year it actually fell by 24.41%. So the falling free cash flow is something we have to keep our eyes out for. So Kroger is growing, but they are growing at quite a low rate, so that is something we have to take into account when predicting our earnings for the Grams valuation. Now, something I like about Kroger is that they have decreasing shares outstanding at a rate of 2% over the past 5 years. And what this essentially means is that you as an investor will own a larger percentage of the company as the market becomes less diluted. And buying back shares is also something that the free cash flow of a company is used for. Now let's direct our attention to the 5-year PE ratio sitting at 12.80, which is in the range we like to see. And what this essentially means is that investors are paying only $12.80 for $1 of Kroger's earnings, which is much lower than what they are paying for any other average company. Now, if we have a closer look, we can see that currently the PE ratio is a little higher, sitting at 16.13, but that is still in the range we like to see, and investors are still paying less for $1 of Kroger's earnings. Now, jumping to the price to free cash flow, which is essentially the same thing as the price to earnings, except we have a look at the free cash flow. We can see that over the past 5 years, again, has been sitting at about 12 and currently is sitting a little higher at 15.48, but again, still in the range we like to see. And this is something I want to point out. If we jump to Seeking Alpha and compare the price of Kroger to their PE ratio, we can see that the blue graph is the price rising from 27 very steadily to currently about 60, while the PE ratio always stays between 10 and 20, with an exception between 2021 and 2022 when the PE ratio was sitting very high, and that was also the reason why Kroger fell from a price of 60 down to a price of about 45. So comparing the price to earnings and free cash flow ratios to the price of the company is a very simple way to understand whether they are over or undervalued compared to what they have been trading in the past. The P ratio should always stay in the range we like to see, so below 22.5, while the stock price moves up. Now jumping back to the 9-pillar analysis, we can also see that Kruger's 5-year profit margin is sitting in the range we like to see. It's sitting at 22.91, and their long-term liabilities over the 5-year free cash flow negative dividends is sitting at 2.46. Now let's have a closer look at this, as this metric essentially tells us whether Kruger generates enough free cash flow to cover all their long-term liabilities, and therefore is very important to analyze, as we don't want the companies we own in our portfolio to have trouble with debt. We can see that overall they have been keeping their long-term liabilities at about $20 billion, but in 2024 they increased them by 46.38% to $32.8 billion. Now thanks to our ratio of 2.46, we can see that Kruger can pay off all their long-term liabilities in about 12.5 years, so they do generate enough free cash flow to pay off all their long-term liabilities, and so are not in danger from this big increase, but it is still something I will keep my eye out for. So overall, Kruger is looking very nice. They are currently undervalued compared to their earnings and compared to their free cash flow, and have very nice consecutive dividend growth, and so they are a great company for someone who is looking to build a growing dividend portfolio. But their profits are growing quite slowly, and I don't think that that will change anytime soon. So now let's calculate the company's intrinsic value, first using our Graham's formula revised. And here I plug in quite low earnings growth estimate for the next 5 years and get an intrinsic value of $50.64, which is actually 22% lower than the current trading price of the company. Now moving to the discounted cash flow model, where we have a look at the free cash flow of the company, I project a growth rate of 5.7% into the next 10 years plus and calculate that future free cash flow. I then calculate the discount rate at 5.9%, which is a little higher than the WACC of the company, as I do want my return to be higher than 3.78%. Now plugging in this discount rate, I calculate the present value of that future free cash flow. I then sum all of that up, add cash and cash equivalents, and subtract total debt, which is quite high, and get an equity value, which I divide by the shares outstanding and get an intrinsic value of $115.80, which is higher than the current trading price. Now for the multiples valuation, we compare Kruger to 4 of its competitors. We take these companies' current stock prices and divide by their earnings per share to get their PE ratios. We then average out these PE ratios and multiply by the earnings per share of Kruger to get an intrinsic value of $104.97, again quite higher than the current trading price of Kruger. And finally, we will have Kruger go through the dividend discount model, where we plug in the dividend over the past 5 years and calculate the very juicy average growth rate of 16.25%. Now project a growth rate of 14.33% into the future, but as this growth rate is higher than the discount rate we projected before, the value comes out negative because of the mathematics within the model, and therefore we have to use our alternative model, where we plug in the next year's dividend calculated by our projected growth rate, and based on the stock price next year predicted by analysts and the discount rate, we get an intrinsic value of $60.40. Now moving to the ultimate valuation, we average out these 4 valuation models and get an intrinsic value of $82.95, which is about 35% higher than the current trading price of the company. And we can see that a margin of safety of 30% is a little too big. So if we plug in a margin of safety of 25%, we see that we get an acceptable buy price at $62.23. Now in my eyes, Kruger is looking very nice. They have very nice steady dividend growth, and they are growing, although at a very low rate. Now something you do have to take into account is that the growth of the stock price of the company is a reflection of their profits growth, and so if Kruger will grow at lower rates over the next few years, you cannot expect high returns, but that is compensated for with their high dividend growth. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe, as it really helps me out.